Hi, everyone. Mark Sorenson, Chief Investment Officer at Royal Fund Management. It's been some time since we've done a market commentary video, and part of the reason is the market's just been doing very well. However, we've run into just a little bit of turbulence as we enter the third quarter. August and November are typically not the best months of the year, and then oftentimes we accelerate later in the year as we get to November and December. So I thought I'd provide a little bit of context today. The market has done extremely well. In fact, since the tariffs were first announced back on April 2nd, you might remember we had a severe correction, but then the market recovered quite quickly and then went on to has gone on to make higher highs and higher highs. But the market oftentimes gets ahead of itself. One of the reasons it's ahead of itself right now is the market is a leading indicator, and the market is looking at artificial intelligence, the new industrial revolution, if you will, and it's looking at all the productivity gains that will cause. You know, some people compare the rally because of artificial intelligence to 1999 and wonder if we're entering into a time where we're into a bubble, if you will. Where things really have to come unraveled. No, we don't believe that. That will probably happen, but we think it's years away. You might remember during the tech bubble at the turn of the century back in 2000, at that time, the S&P 500 got to about 40 times earnings. We're only slightly half of that right now, a little over 20 times forward earnings. And yet the companies today have real cash flow and real earnings. Back during the internet revolution of the early 2000s, you know, companies were being valued based on the number of clicks or page views. Companies didn't even have real earnings. So we think this is very different. We think artificial intelligence will add a lot of productivity. Right now, we're seeing big gains in the companies that are directly involved in our artificial intelligence, like NVIDIA, like Microsoft, some of the software stocks as well, the chip stocks that are building the infrastructure in particular. That has created a unique situation in the market where only a few stocks are driving the performance of the S&P 500. But we do think the market will broaden out, which will be part of what carries the market higher later in the year. For example, this is almost unprecedented. There are only 9 stocks in the NASDAQ 100 index, 100 stocks, only 9 of them represent half the value of the NASDAQ 100. NVIDIA is 8% of the value of the NASDAQ 100 when it's only 1 stock. So that concentration of performance is helping the market to do very well, and yet the broader market is not doing as well. So I'm going to share my screen. We'll talk about that, and I'll show you. This is a chart. Let me share my screen. This is a chart. The green line is the S&P 500 growth ETF. The blue line is what's called the equal weight S&P 500 shares. So in other words, if every stock in the S&P 500 was equal weight, it would have gone up 12.97% over the last year, whereas the S&P 500 growth ETF has gone up 34.11%, nearly triple what the equal weight stock has done in the S&P 500. So what's driving performance is just a few shares. We anticipate that we're likely going to have a little bit of profit taking, backing and filling as we enter into the latter part of August and September. However, we think that dip will be bought. We think we'll recover from it in a relatively short period of time. We do anticipate that the market will broaden out the latter half of the year. And we expect the market to be much higher by year end. We also have the Fed put now, if you will. You may have heard commentators talk about the Fed put. That just simply means that if we have some weakness in the labor market, like we saw last Friday, that increased the odds that the Fed was going to cut interest rates at their September meeting. In fact, those were expecting 2 cuts before year end are now prognosticating 3 interest rate cuts. So that'll do 2 things. One, that will help the economy, which is weakened a little bit because of tariffs and the cost of tariffs. It'll also, help the stock market itself. In particular, help the market to broaden out, meaning that other stocks, other than just a handful, start to perform. Lower interest rates, that's the cost of capital for companies to run, start, or grow their business. So lower interest rates will propel more profitability as we go later into the year. The other thing that's interesting is we still anticipate that growth will recover. A little bit of a slowdown now, maybe a little bit of a backing and filling, profit-taking period of time. You just go through that because we expect growth to accelerate later in the year, and we're expecting a lot of deregulation that will help corporate profitability as well. So with the Fed on our side, AI, industrial revolution, artificial intelligence, still we think in the early to mid innings. We think AI will create a lot of profitability, not for those companies that are just developing the tools, but for all companies as they use AI to become more efficient, increase their margins, and help with their profitability. Tariffs were a big concern back in April. The market has learned to deal with that. A little bit of tariff uncertainty again right now, but we actually think bringing back some productivity to the U.S. Will be positive over time, and we do not anticipate companies will pass all the cost of tariffs on to the consumer, which would impact inflation. In fact, even Fed Chairman Jerome Powell has said inflation is headed the right direction, but we might have a little one-time spike in inflation because of tariffs. But overall, they expect to be able to look past that and lower interest rates likely the balance of the year. Also, I wanted to show you just some interesting statistics about the market of late. In the second quarter of 2025, it was the first time since 1938, the first quarter of that year, that the S&P 500 was down 10% in a single quarter. At the same time, it was up 10% in a single quarter. And that was interesting. That happened because of the fear of tariffs starting in April, but then the market recovered so quickly that in one quarter, we actually had the market down 10% and up 10% in the same quarter. There's only been 3 other times that happened, and you'll note that was 1931, 1933, 1937. In addition to 1938, all of that, of course, is during the Depression years. And this is the first time that we've had the market be down 10% in a single quarter and up 10% in the same quarter, and yet the market still finished higher for the quarter. Another interesting stat is that in the first 6 months of this year, both the S&P 500 and the Bloomberg Aggregate Bond Index both went up 4%. The bonds rallied 4%, and the S&P, the equity market, went up over 4%. Sorry. Since 1990, the other 4 years when stocks and bonds both gained 4% in the first half of the year, the market traded higher in the second half of the year, all 4 times, with median gains of 12.6% for stocks and 4.5% for bonds. And then finally, we had this huge rally. I mentioned the April tariffs created a fearful time in the market, and then we had the huge rally. In the 3 months ending July 8th, the NASDAQ composite rallied 33.3%, the largest 3-month gain since June of 2020. What happened in 2020? We had the COVID scare, and then the market rallied back very quickly. In the 7 prior periods, when the index rallied 33.3% or more in 3 months, the median gain for the rest of the year was 16.8%, and the market was up 6 out of those 7 times. So with that being said, we think the market's a little bit ahead of itself in the short term, a little bit of profit taking, a little bit of backing and filling. Maybe another little scary moment might be ahead of us, but we anticipate that it'd be better to ignore that. Think with your heads and not your hearts, and we think the latter 3 months of the year will likely be very strong as growth continues to accelerate off a little bit of weakness right now, and we get more deregulation, and the AI trade continues to drive the markets. However, even if the AI trade starts to lag a little bit, we think lower interest rates will propel the rest of the market to play catch up and help the indexes improve dramatically. So thank you for your trust and your confidence. We thought we'd put a little bit of a video out because of the little turbulence we're running into right now, but we expect any pullback to be relatively shallow and short-lived, and we expect the market to be much higher by year end. Thanks, everyone. Enjoy the rest of your day. Bye now.